What if I told you that you don't need millions connections or perfect timing to build real wealth? According to David Tepper, one of the most aggressive investors alive, 500,000 is more than enough if your mindset is right. Stay with me, because this could completely change how you think about money. David Tepper didn't win by being lucky. He won by thinking differently when others panicked. This video breaks down why Tepper believes $500,000 is all you need to build serious wealth, and how discipline, preparation, and courage matter more than starting capital. This isn't hype, it's a mindset shift. Tepper's belief is simple: money is a tool, not the edge. Too many people obsess over the size of their capital, convinced that more money automatically guarantees success. David Tepper's career proves the opposite. What truly separates winners from losers in the market is not how much money they start with, but how they think and act when pressure is highest. Capital only amplifies behavior. If someone lacks discipline, patience, and clarity, adding more money simply magnifies their mistakes. On the other hand, when capital is paired with a calm, focused, and prepared mindset, even a relatively modest amount can produce extraordinary results. Decision-making under pressure is where fortunes are made or destroyed. Markets are emotional machines. Fear, greed, panic, and overconfidence constantly push prices away from reality. Most investors know what they should do in theory, but fail to execute when emotions take control. Tepper understood early on that the ability to stay rational while others are losing control is a massive edge. When headlines scream disaster and prices collapse, emotional investors freeze or sell at the worst possible moment. Disciplined investors step back, assess the facts, and act with intention. That gap in behavior is where opportunity lies. The comparison between 500,000 and 5 million highlights a hard truth. Someone with 5 million who reacts emotionally, chasing hot trends, holding losses out of ego, or panicking during downturns can destroy years of progress in a short time. Large capital does not protect against bad decisions, it only increases the cost of being wrong. Meanwhile, a disciplined investor with 500,000 treats every decision with respect. They manage risk carefully, size positions wisely, and wait patiently for high probability opportunities. Over time, consistency beats scale. Tepper's approach shows that confidence does not come from money itself, but from preparation. When you have done the research, understand the downside, and know why an opportunity exists, pressure loses its power. Emotional reactions are replaced by calculated responses. Instead of asking, "What if I'm wrong?" the disciplined investor asks, "What do the odds say?" This shift in thinking changes everything. It allows action when others hesitate and restraint when others rush in blindly. Another key part of this belief is survival. Tepper knew that staying in the game matters more than winning every trade. Disciplined decision-making protects capital during bad periods and positions it for explosive growth during good ones. With 500,000, avoiding catastrophic mistakes is far more important than chasing massive wins. Over time, smart decisions compound, and compounding does not care where you started. It only cares how consistently you perform. Ultimately, Tepper's lesson is empowering. It removes the excuse of not enough money and replaces it with responsibility. The edge is not external, it is internal. Master your emotions, respect risk, and make decisions based on logic instead of fear. Do that consistently, and $500 becomes more than enough. Fail to do it, and even $5 million won't save you. Idle money is dead money, and David Tepper built his entire philosophy around this truth. He understood that capital sitting still is not safe. It is slowly losing value to inflation, missed opportunities, and time. Money is meant to work, not to hide. However, this does not mean reckless action or constant trading. Tepper's lesson is deeper capital should always be position ready and flexible so that when opportunity appears, you can move instantly. Wealth is not created by waiting for perfect conditions, because perfect conditions never arrive. Many investors fall into the trap of endless waiting. They want absolute certainty, flawless data, and full confirmation before making a move. Tepper rejected this mindset completely. Markets reward preparation, not perfection. By the time conditions look safe, prices have already adjusted and the real opportunity is gone. Tepper prepared in advance, studying balance sheets, understanding macro forces, and defining risk long before he invested a single dollar. That preparation allowed him to act decisively when others were still debating. Fear is the greatest creator of value in financial markets. When panic spreads, logic disappears. Prices fall not because businesses suddenly become worthless, but because investors are desperate to escape uncertainty. Tepper saw fear as a signal, not a warning. While most people interpreted fear as a reason to retreat, he saw it as a moment when odds shifted dramatically in favor of the prepared investor. Capital that is positioned, liquid enough, flexible enough, and backed by conviction can be deployed aggressively at exactly these moments. Being positioned does not mean being fully invested at all times. Tepper knew the importance of patience. Sometimes positioning means holding cash, sometimes it means selective exposure, and sometimes it means bold concentration. The key is intentionality. Every dollar has a purpose. Idle money has no plan, no direction, and no role in a broader strategy. Positioned capital, on the other hand, is waiting with clarity. It knows when to move and when to stay still. Another powerful part of Tepper's mindset is speed. Opportunity windows are short. When fear peaks, it doesn't last long. Those who hesitate miss the moment. Tepper trained himself to move fast because his preparation eliminated doubt. He already knew the downside, accepted the risk, and understood the reward. This allowed him to act while others were paralyzed by uncertainty. This philosophy also demands emotional discipline. Acting during fear feels uncomfortable by design. The market makes opportunity painful so that most people avoid it. Tepper embraced that discomfort. He trusted his work more than his emotions. Instead of reacting to noise, he responded to mispricing. That difference separates average investors from elite ones. In the end, Tepper's lesson is clear: money that waits for comfort dies slowly, while money that is prepared grows. You don't chase opportunity, you position yourself so opportunity finds you. When fear creates value, the prepared investor doesn't hesitate, they act. Tepper doesn't avoid risk, he understands it. This distinction is at the core of his success and is where most investors completely misunderstand what risk really is. Many people believe risk means volatility, uncertainty, or temporary losses. Tepper saw it differently. To him, real risk was acting without knowledge, conviction, or preparation. Ignorance, not boldness, is what destroys capital. When you don't know why you're in a position, when you haven't studied the downside, or when you're relying on hope instead of analysis, that's when risk becomes dangerous. Bold action has a bad reputation because people confuse it with reckless behavior. Tepper proved that aggressive moves, when backed by deep research and clear reasoning, are not gambling at all. They are calculated decisions made when the odds are heavily skewed in your favor. Gambling depends on luck. Execution depends on understanding. Tepper spent countless hours studying companies, balance sheets, macroeconomic conditions, and policy decisions so that when opportunity appeared, he already knew what to do. His aggression was the result of certainty built through preparation. Understanding risk also means knowing the downside before thinking about the upside. Tepper always asked, "What happens if I'm wrong?" He didn't fear losses, but he respected them. By defining the worst-case scenario, he removed emotional surprises. This clarity allowed him to size positions intelligently and stay calm when markets moved against him temporarily. Panic comes from uncertainty. Confidence comes from understanding. When you know your risk, price fluctuations lose their power over your emotions. Another crucial element of Tepper's mindset is probability. He didn't need to be right all the time. He needed to be right when it mattered most. By waiting for moments when fear distorted prices, he placed himself in situations where the potential reward far outweighed the potential loss. In those moments, not acting would have been riskier than acting. Sitting on the sidelines while opportunity passes is a hidden risk that many investors ignore. Tepper understood that avoiding action can be just as costly as making a bad move. Stepping in aggressively also requires emotional control. Markets test conviction constantly. Even the best ideas can face short-term pain. Investors who act without understanding quickly lose confidence and exit at the worst time. Tepper's conviction allowed him to hold firm, not because of ego, but because the facts supported his position. He trusted his process more than market noise. This approach transforms fear into focus. Instead of asking, "What if I lose?" Tepper asked, "What do I know that the market is ignoring right now?" That question shifts your mindset from defense to offense. Risk becomes manageable, measurable, and acceptable. Ultimately, Tepper's lesson is empowering. You don't eliminate risk by playing small. You eliminate destructive risk by educating yourself. When you've done the work, bold action is not reckless. It's responsible. It's execution at the highest level. Before thinking about profits, Tepper protects survival. This principle sounds simple, but it is one of the most powerful reasons behind his long-term success. Many investors enter the market obsessed with upside, how much they can make, how fast they can grow, and how big the win could be. Tepper flipped that thinking completely. His first question was never about profit. It was always about damage control. What can I lose? Came before any discussion of gains, because without survival, profits are meaningless. Survival is the foundation of compounding. You cannot benefit from future opportunities if you are wiped out today. Tepper understood that the market does not reward one-time brilliance if it is followed by permanent loss. A single catastrophic mistake can erase years of smart decisions. That is why he treated risk management as non-negotiable. By clearly defining downside, he removed the possibility of fatal errors. This allowed him to stay active, adaptable, and ready for the next opportunity even after setbacks. Asking, "What can I lose?" forces clarity. It makes you analyze worst-case scenarios instead of ignoring them. Tepper didn't assume things would go right. He assumed something could go wrong and prepared for it. This preparation shaped position sizing, entry points, and exit strategies. When losses were limited and controlled, fear lost its grip. The market could move against him temporarily without forcing emotional decisions. That emotional stability is a competitive advantage most investors never develop. Only after downside was understood did Tepper ask the second question. What can I gain? This sequencing matters. When upside is evaluated without first understanding risk, investors become blinded by optimism. Tepper avoided this trap. He looked for situations where the potential reward was dramatically larger than the potential loss. These asymmetric opportunities allowed him to be aggressive without being reckless. Big wins didn't come from constant action. They came from rare moments where the math made sense. This mindset also explains why Tepper could act with confidence during chaos. In volatile markets, uncertainty feels overwhelming. But when you already know your maximum loss, uncertainty becomes manageable. Tepper didn't need the market to calm down before acting. He needed the odds to be right. Once they were, hesitation became more dangerous than action. Another critical benefit of this approach is longevity. The market is a long game. Those who survive the longest often win the biggest. Tepper's focus on survival allowed him to learn, adapt, and evolve through multiple market cycles. Each downturn became a lesson instead of a disaster. Each recovery became an opportunity instead of a relief. This philosophy removes ego from decision-making. It's not about being right, it's about staying alive. Tepper didn't need to prove anything to the market. He needed to protect his ability to play tomorrow. By respecting downside first, he earned the right to chase upside later. In the end, this mindset is what keeps investors in the game long enough to win big. Protect survival, control losses, and let time and discipline do the heavy lifting. Tepper made his name during chaos and his career as a masterclass in turning fear into opportunity. While most investors retreat when markets collapse, Tepper saw a completely different picture. To him, market crashes were not disasters. They were transfers of wealth, moving from the fearful and unprepared to those who had the courage, knowledge, and capital to act decisively. He understood that panic drives prices below intrinsic value, creating opportunities that only the prepared can exploit. While the world focused on fear, Tepper focused on value. This perspective allowed him to take advantage of situations that others could not even process. The lesson is clear: downturns are not a signal to hide, but a signal to analyze. Tepper spent years studying patterns, understanding balance sheets, and following economic signals so that when a crisis arrived, he could act immediately. Preparation was everything. With $500, an investor can't simply wait and hope for recovery. They must position themselves strategically so that when fear peaks, they have both the liquidity and the insight to move. Tepper didn't need billions to capitalize on chaos. He needed readiness, patience, and conviction. This mindset flips the conventional fear-based narrative on its head. During a market crash, emotions dominate the crowd. Fear and uncertainty push investors to sell, often at prices far below intrinsic value. Tepper saw this as the exact moment when opportunity was richest. While others were losing confidence and exiting positions, he was analyzing what assets were undervalued and what sectors had the strongest fundamentals. This allowed him to concentrate his capital on positions with asymmetric upside, where the potential gains vastly outweighed the potential losses. In chaotic markets, hesitation is costly, and Tepper's preparation ensured he was never hesitant. Another key factor in Tepper's success is his understanding of timing. Crises are unpredictable, but history shows that panic reaches a peak before recovery begins. Tepper learned to recognize the signals of peak fear, extreme price drops, widespread pessimism, and narratives of doom dominating headlines. When these signals appeared, he acted aggressively. The 500 zalozens in the hands of a prepared investor can be deployed with impact, turning what seems like a small amount into exponential returns over time. Timing plus preparation multiplies opportunity. Tepper's approach also required emotional discipline. Acting in chaos is uncomfortable by design. Fear is contagious, and the majority of investors are swept away by it. Tepper trained himself to detach from the crowd mentality, to focus on facts rather than headlines, and to trust his analysis over popular opinion. This mental toughness allowed him to view crises not as threats, but as catalysts for growth. Every downturn became a chance to build wealth, not a reason to panic. Ultimately, Tepper's philosophy demonstrates that wealth isn't just made in calm markets. It's made in moments of extreme volatility. Market crashes don't destroy wealth. They redistribute it. With 500 ZAOs and careful preparation and disciplined action, downturns become launch pads rather than disasters. The key is courage, knowledge, and readiness to act when fear dominates. Those who prepare can turn chaos into opportunity, just as Tepper did time and time again. Over-diversification often hides fear, and this is something David Tepper understood better than most investors. Many people spread their money across dozens of positions, not because it is optimal, but because they are afraid of making mistakes, afraid of losing, and afraid of being wrong. This kind of safety-seeking behavior might feel prudent on the surface, but in reality it dilutes both focus and returns. Tepper recognized that true opportunity comes from conviction, not from spreading yourself thin. By over-diversifying, an investor may reduce individual risk slightly, but they also reduce their ability to capitalize on the positions that truly matter. The result is mediocrity instead of excellence. Tepper's approach was the opposite. He concentrated his capital where the odds were overwhelmingly in his favor. He spent immense amounts of time researching, analyzing, and understanding each opportunity before committing significant funds. The goal was not to be everywhere, but to be right where it counted most. One well-researched, high-conviction position could outperform dozens of smaller, weaker investments combined. This is a mindset that separates elite investors from average ones. Tepper understood that success in the market is less about quantity and more about quality, less about safety in numbers and more about decisive action. Concentration requires courage. It requires the confidence to act even when everyone else is hesitant or fearful. Most investors over-diversify because they fear being wrong, because the market is uncertain, or because they lack complete conviction in their analysis. Tepper turned that fear into preparation. He eliminated uncertainty through study and experience, allowing him to place large bets with clarity. Each concentrated position was a calculated risk, not a gamble. He knew the downside, assessed the upside, and acted only when the probability favored him strongly. This disciplined concentration magnified both potential returns and his ability to make bold moves in times of chaos. Another key element of Tepper's strategy is focus. Over-diversification can spread attention too thin, leaving an investor unable to truly monitor or respond to shifts in the market. Tepper understood that deep understanding of a few positions is far more valuable than superficial knowledge of many. By concentrating, he could actively manage his investments, make quick decisions when conditions changed, and exploit market inefficiencies before others noticed. The power of focus is often underestimated, but Tepper made it central to his success. Moreover, high-conviction investing creates compounding opportunity. When a well-researched position performs as expected, the gains can be reinvested into other high-probability opportunities, further amplifying wealth. Tepper's concentrated bets were not reckless. They were precise and calculated. He didn't need dozens of small wins to succeed. He needed a few significant victories executed with discipline and insight. Ultimately, Tepper's lesson is profound fear disguised as caution often leads to mediocrity. By concentrating when the odds are in his favor, he leveraged preparation, knowledge, and courage to achieve extraordinary results. One well-researched, high-conviction move can outweigh dozens of weak ones, turning focus and conviction into a force that outperforms both markets and peers alike. Concentration, executed intelligently, is not risk, it is power. Most investors fail not because of bad ideas, but because of bad emotions. The markets are designed to challenge human psychology. Fear, greed, impatience, and overconfidence constantly influence decisions, often overpowering logic and research. Even the best investment thesis can collapse if an investor succumbs to emotional impulses. David Tepper understood this more than most. He realized early in his career that emotion, not strategy alone, determined long-term success. While ideas can be taught and analyzed, emotional discipline must be cultivated, practiced, and reinforced daily. It is the hidden multiplier of capital, often more powerful than any technical insight or market prediction. Tepper's brilliance lies in his ability to remain calm when others panic. Market crashes, economic uncertainty, or sudden corporate turmoil often trigger widespread fear. Most investors react instinctively. They sell in haste, abandon rational analysis, and follow the herd. Tepper, however, saw these moments as opportunities rather than threats. By staying calm, he could assess situations objectively, separate noise from fact, and identify undervalued assets that the frightened majority was abandoning. Calmness allowed him to act deliberately, making high-probability decisions that would pay off in the medium and long term. Where panic leads to losses, calmness leads to opportunity. Equally important is Tepper's ability to be aggressive when others freeze. Many investors hesitate when fear dominates the market, waiting for certainty that never comes. Tepper flipped that hesitation into action. His preparation and knowledge gave him the courage to step in aggressively at moments when others were immobilized by doubt. This contrast, aggressive action against a frozen crowd, is what generates extraordinary returns. While the masses wait for confirmation, Tepper captures value at discounted prices, positioning himself for outsized gains. This is not reckless behavior. It is the calculated exploitation of emotional imbalances in the market. Emotional discipline also extends to patience and risk management. Tepper does not allow euphoria or greed to cloud judgment. Even in bull markets, he evaluates each opportunity critically, knowing that excessive optimism can be just as dangerous as panic. Similarly, when things go against him temporarily, he does not react impulsively. He trusts his analysis, respects risk, and avoids letting short-term swings dictate behavior. This steadiness compounds over time, transforming moderate wins into exceptional growth while avoiding catastrophic losses that derail careers. Another subtle advantage of emotional control is clarity of thought. When fear or excitement dominate, judgment becomes distorted. Tepper's calm mindset allows him to see opportunities others miss, recognize mispricings, and act decisively when timing is critical. The ability to detach from market noise, assess risk objectively, and act when odds are favorable creates an exponential advantage that no technical strategy alone can replicate. Emotional discipline is, in essence, leverage for the mind. Ultimately, Tepper's lesson is clear capital grows faster when the mind is in control. Emotional discipline multiplies returns more than clever strategies, complex models, or insider insights. Staying calm when others panic and moving decisively when others freeze transforms $500 and $1,000 into a platform for extraordinary wealth. In the world of investing, mastering emotions is not optional. It is the ultimate competitive edge. Mistakes are expensive, and in the world of investing, repeating them can be fatal. David Tepper built his reputation not by avoiding errors entirely, because no one ever does, but by learning from them quickly and refusing to make the same mistake twice. Every misstep in the market carries a price, and in Tepper's view, the difference between a temporary setback and a career ending loss is the speed at which an investor adapts. Hesitation, denial, or pride can turn a recoverable error into a catastrophic one. Tepper recognized that the markets are relentless. They do not forgive repeated mistakes, and time waits for no one. Survival and ultimately success depends on how quickly you internalize lessons and adjust your strategy. Tepper's approach to mistakes begins with ruthless honesty. He analyzes every error, stripping away excuses and emotion to understand exactly what went wrong. Was it a misreading of the fundamentals, a failure to account for macroeconomic conditions, or was it simply emotional impulsiveness? By identifying the root cause, he ensures that the lesson is embedded and future decisions are stronger. This analytical rigor is what separates elite investors from the rest. Mistakes are not failures, they are feedback. Tepper treats each loss as a learning opportunity, and the faster the feedback loop, the faster he grows. Cutting losses quickly is another cornerstone of Tepper's philosophy. One of the most common ways investors compound mistakes is by holding onto losing positions out of hope, pride, or stubbornness. Tepper does the opposite. When a position does not perform as expected, he acts decisively. Cutting losses swiftly preserves capital, frees resources for higher probability opportunities, and prevents small errors from turning into career-altering disasters. This discipline ensures that $500, $1,000, or any starting capital is not wasted on positions that no longer make sense. Capital efficiency combined with quick adaptation magnifies long-term returns. Adaptation also requires constant evolution. Tepper never relied solely on old methods, no matter how successful they had been. He recognized that markets are dynamic, and strategies that work today may fail tomorrow. By continuously refining his process, studying new data, and adjusting to changing conditions, Tepper stayed ahead of the crowd. Learning speed is the ultimate multiplier. The faster you internalize lessons and incorporate them into your strategy, the more resilient and profitable you become. With $500,000, speed of learning can be the difference between growing wealth exponentially or watching it erode silently. Another critical aspect of this mindset is humility. Tepper's ability to admit mistakes quickly, without ego, allows him to act decisively. Pride is the enemy of adaptation. Stubbornness is a slow path to ruin. By accepting that errors are inevitable and focusing on improving with each one, Tepper ensures that his losses are temporary and his wins are amplified. Ultimately, the lesson is clear: mistakes are inevitable, but destruction is optional. The difference between growing 500,000 into a fortune or watching it disappear lies not in avoiding errors, but in how fast you learn, adapt, and evolve. Speed, discipline, and humility transform mistakes into stepping stones, making growth inevitable for those who embrace the process. Tepper waits relentlessly for the right moment, and this patience is one of the defining traits of his investing philosophy. In a world obsessed with constant activity, daily trading, and chasing the latest trend, Tepper's approach is almost counterintuitive. He understands that wealth is not created by doing something all the time. It is created by doing the right thing at exactly the right moment. Every opportunity in the market has a price, and timing determines whether a decision multiplies wealth or destroys it. Tepper's genius lies in his ability to recognize when the odds are overwhelmingly in his favor and to wait patiently until that moment arrives. Chasing trends is the path most investors take, but Tepper avoids this trap entirely. Trends are temporary, often driven by emotion rather than underlying value. Following the crowd may feel safe, but it rarely leads to extraordinary returns. Tepper instead focuses on mispricing, the moments when fear, panic, or ignorance push an asset far below its intrinsic value. These situations do not happen daily. They emerge rarely, often in times of crisis. Recognizing them requires preparation, study, and a deep understanding of both markets and human behavior. Tepper waits not because he is passive, but because he knows that disciplined patience amplifies the power of every dollar he deploys. Waiting relentlessly also requires emotional control. It is not easy to sit on the sidelines while others are making noise, trading constantly, or reacting impulsively to headlines. Most investors feel the pressure to act, driven by fear of missing out. Tepper has mastered the ability to resist this pull. He focuses on facts, probabilities, and valuations rather than hype. This detachment allows him to strike when others are hesitant, creating a situation where risk is minimized and potential reward is maximized. Wealth, in this sense, is a product of disciplined restraint, not frenetic activity. Perfectly timed action also multiplies the impact of capital. Tepper understands that investing is a game of asymmetry, where a well-timed move can produce returns that far exceed the initial investment. By waiting for the right moment, he ensures that each deployment of capital has a high probability of success. This strategy allows him to take aggressive positions with confidence, knowing that the risk-reward ratio is favorable. With $500 or any amount of capital, the principle is the same. Careful preparation plus precise timing generates results that constant, unfocused action cannot. Moreover, patience allows Tepper to learn and observe the market while waiting. He studies patterns, analyzes valuations, and monitors investor behavior. This continuous observation sharpens his judgment, reduces mistakes, and ensures that when the moment comes, his actions are decisive and informed. In a sense, waiting is not an activity. It is preparation in disguise. It is the mental and analytical work that precedes the moment of execution. Ultimately, Tepper's lesson is simple, but profound. Wealth is not built by constant movement, but by perfectly timed action. Chasing trends produces noise. Waiting for mispricing produces results. Discipline, patience, and preparation turn opportunity into fortune. Proving that in investing, timing is everything. 500,000 is enough if you think like an owner, not a gambler. This distinction is the foundation of David Tepper's philosophy and the reason he could turn relatively modest amounts of capital into extraordinary wealth. Thinking like a gambler means chasing luck, acting impulsively, and hoping for outcomes you cannot control. Thinking like an owner, on the other hand, means taking responsibility for your decisions, analyzing every opportunity carefully, and treating capital as a tool to be deployed intelligently. Ownership is about mindset. You act with foresight, discipline, and confidence rather than emotion and chance. Tepper understood that the true edge in investing is not how much money you have, it's how you think and act with it. Respecting risk is the first principle of ownership. Tepper never approached an opportunity blindly or without understanding the potential downsides. He always asked, "What can I lose?" before considering potential gains. Respecting risk doesn't mean avoiding it. It means acknowledging it, measuring it, and planning for it. With 500,000, ignoring risk is fatal. Every decision must be informed, and every position must be sized relative to what you can afford to lose. By respecting risk, Tepper preserved capital, maintained optionality, and created the freedom to act aggressively when true opportunity appeared. Preparation is the second pillar. Tepper prepared obsessively before making any move. He studied companies' industries, macroeconomic trends, and investor psychology. He built mental models and stress, tested his assumptions so that when a crisis or opportunity emerged, he could act decisively. Preparation turns uncertainty into clarity. It allows you to see value where others see only fear or confusion. With 500 Zawin, preparation magnifies your impact. You can act confidently because you have anticipated scenarios, understood the downside, and identified the asymmetric upside. Acting decisively is where owners differentiate themselves from the crowd. Tepper didn't hesitate when the moment came. He had done the work, understood the risk, and was ready to deploy capital quickly. Speed is crucial in markets. Opportunities are fleeting, and hesitation often means the difference between success and missed potential. Tepper's decisiveness allowed him to take advantage of mispricings, market panics, and moments of collective fear. Each well-timed action multiplied the effectiveness of his capital, proving that wealth is a product of execution as much as analysis. Finally, striking when the moment arrives requires courage. Tepper's philosophy combines preparation, discipline, and emotional control. When fear dominates the market, most investors freeze. Tepper saw that as the exact moment to act. With 500,000, a well-timed, high-conviction position can create life-changing returns. Thinking like an owner means you don't wait for permission, you don't second-guess endlessly, and you don't let fear paralyze you. You trust your analysis, you respect the risk, and you strike with confidence. Ultimately, Tepper's lesson is that money alone does not create wealth. Mindset, preparation, risk management, and decisive action do. 500,000 is more than enough if you treat it as a tool for ownership rather than a ticket for gambling. When you combine respect for risk, obsessive preparation, and the courage to act decisively, every opportunity becomes a chance to multiply capital, build real wealth, and achieve extraordinary results. You don't need billions to think like David Tepper. You need courage, clarity, and discipline. Train your mind, respect chaos, and when fear takes over the market, step forward while others step back. That's how $500 becomes life-changing wealth.